Hello everybody and welcome back to GMD Investments. You'll be surprised, but making money on the stock market is not as hard as you think and doesn't require high IQ or extreme levels of intelligence at all. What it requires is the correct discipline, patience and principles. Just by investing in a low-cost index fund such as the S&P 500 and adding to it over time, you can compound your money into something golden. For example, if you bought your $28,000 home and paid a $280 monthly mortgage from 1972 to 2001, around 2001, your home would be valued at $230,000. But what if instead of buying that home, you had invested that money into the S&P 500? If you had put $280 a month into the S&P 500 from 1972 to 2001, you would have over $950,000 by 2001 after reinvested dividends. This doesn't even include your down payment. Had you invested your down payment as well, you would have over $1 million by 2001. The S&P 500 isn't the only great investment out there. One I love the most is Berkshire Hathaway. As we can see, $19 in 1964 would be worth $290,000 in 2018, and today that would have gone up even more, significantly higher in value. The amount of wealth that Warren Buffett has created with Berkshire for many people across the world is astronomical, and is why he is widely known as the best investor to ever live. It's not just the investment decisions and returns that I'm drawn to either when it comes to investing in Berkshire. As shown on the graph, Berkshire has a whopping $128.2 billion in cash on hand, so they are ready to capitalize on any market crash that may take place, and also are not highly leveraged at all, and in fact have little or no debt, as Buffett himself understands the potential risks of high leverage, etc. The culture and investing mindset that they have created at Berkshire truly is amazing, and I myself will be invested in them for a very long time. In 1993, in a Berkshire Hathaway annual meeting, Mr. Buffett said that investing is not that complicated. Other than learning accounting, which is the language of business, the real key to investment success is to have the right mindset with a temperament compatible with those principles. You may think large diversification is a good thing, but it's actually not as good as you think. When you diversify across all areas, yes, it minimizes the risk of loss, but that means it also minimizes reward. It's better to find 8 to 10 solid companies and bet big to get that maximum return. Mr. Buffett actually also states this in the annual meeting, saying few humans have an edge if they try to follow 40 companies or more. 8 or 10 in a lifetime, or even one, will give a far better chance of getting positive returns. Mindset in life is everything, and if you truly want to succeed, you have to take up one idea, make that idea your life. Think of it, dream of it, live on that idea. Let the brain, muscles, nerves, every part of your body be full of that idea and leave every other idea alone. This is the way to true success. Buffett's 4 simple criteria for picking stocks include: firstly, a company that you can understand very well. Secondly, a company with favourable long-term prospects. Thirdly, the company is operated by honest and competent people. And lastly, the stock is available at a very attractive price, giving us that margin of safety. The thing that makes Mr. Buffett so successful is the good habits and principles that he has formed through the years, and how he sticks to them no matter what the crowd is saying. If you're continuously changing your mind, buying and selling positions, it opens up more chance in error, and also means you pay more and more fees to your broker and the taxman through something we call capital gains tax. By holding out long term, you have a much higher chance in being successful in the stock market in general, and it's a great way to compound your money over time and gain them wonderful dividends for holding the stock. In this game, slow and steady wins the race. The 2 times rule is something I like to follow, meaning whenever you spend money, you have to put the same amount into investments. This stops the guilt of spending, as you want to keep quality of life, but also determines that you keep saving and investing money to build wealth over time. This concludes this video today. I'm aware this was a shorter video, but I felt I didn't want to go into too much detail to the point where I was confusing people, because investing shouldn't be made to be confusing. It's quite a simple task. If you go down the stock picking route, then yes, it's a lot of work involved, but the point I've made today, you don't have to, and you can be strongly involved in passive investing, and in fact, most stock pickers that try and beat the market don't. It's just that harsh reality. I'd like to thank everyone for watching this video, and if you enjoyed the video, subscribe for more content going forward and stay up to date with market news, investing ideas, and the like. It's been a pleasure. Until next time.